evening and welcome to Chesapeake Public Schools Family Empowerment Webinar presented by the Office of Family and Community Engagement, FACE. I am Ana Medina, one of the FACE specialists. Our office, which is under the Department of Engagement, seeks to create meaningful partnerships in order to inspire, engage, and empower families, educators, and community agencies to support the initiatives of Chesapeake Public Schools. We are typically available Monday through Friday from 8 a.m. to 4 p.m. and can be reached by our main phone line at 757-482-5923 or FACE, FACE, at cpschools.com. We are happy to offer our families a course catalog entitled Peak Parent University that outlines all of our events for the school year. You can also catch up on pre-recorded webinars, access a wealth of educational resources, and make community connections to promote your family's well-being. Please visit www.cpschools.com and search Peak Parent University. We thank you for joining us tonight for our webinar, A Place to Call Home. We are excited to have joining us panelists from Chesapeake Redevelopment and Housing Authority and Onyx Realty professionals. Before we begin, I want to let you know this webinar is being recorded to share on our Chesapeake Public Schools YouTube channel. Participants' cameras and the chat feature are disabled. If you have any questions, please use the Q&A feature located about the bottom of the screen. We will answer all questions by the conclusion of each segment of tonight's presentation. And now we would like to introduce our panelists. First, we have Mr. Gregory Peoples, a family self-sufficiency coordinator, and also Ms. Shonda Taylor, realtor. Welcome, panelists. Thank you for being here tonight. At this time, I would like to turn the program over to Mr. Peoples.
So self-sufficiency will look different for everyone. And like I said before, and it will look different for everyone because, you have families that have deals with different barriers in life. So we could go to the next slide, please. So there's two features of our program. And the first one is the case management. So one of the key things here we do at Chesapeake Redevelopment Housing Authority, we are partnered with communities with a whole lot of resources. And remember, I talked about, we have families that may go through different barriers. And so one of the things that for this program, especially working with the coordinator, which is myself, we work closely together. And basically what we do, we provide those resources. And with those resources, we try to meet the needs of my clients. So one of the key things about this program, you would set goals. So those goals could be anything for as what you want to do. It could be if you want to build your credit, or you want to buy a new car, or you want to go to college. So we have resources that we can provide for you. Just like it says in the point number 2, is accessing services in the community, providing ongoing support, meeting with clients at least once a month, whenever additional assistance is needed. So we work very closely with our clients. And as you can see, the service coordination going on right there. I mean, we have services like childcare, home ownership, tech, vocational schools. So we have a bunch of resources. We go to the next slide. All right, let's look at goal setting. So one of the things about this program, like I mentioned before, just to reiterate, when you're in this program, you're gonna set goals for yourself. Now, these goals may look different for each individual, but let's look at some of the points here that it could be, yourself looking at completing a specific job training, skill training, or obtaining a license or certificate, or even obtaining a GED or a high school equivalent credential, or even attaining a associate degree, or even a bachelor's degree. And also, I believe this program is really, the core value of this program is really home ownership, getting you ready, prepared for training to be a homeowner. And also, we have developing a budget, increasing credit scores, and also your goal could be completing a financial education course. We'll go to the next slide. So when you look on the right there, that's just a little picture of how that that sheet will look, that form will look, and it's called an individual training and services plan. So the individual training and services plan, which we also call the ITSP, is a part of a contract of participation, and it is where the goals identified by the participant are recorded, and basically what you do is basically you put down the goals that you would like to meet, achieve. And a lot of times, when we put down our goals, and I like to call it a motivator, where we put certain dates. When do you want to achieve this goal? Of the course of the period of the program. Now, this program could last 5 years, but I have clients that graduated from this program earlier than that. I mean, with the success stories, I don't have them with me, but at the same time, I believe it'd be very beneficial for, especially for low income families. That's all I have for this program. And of course, if you have any questions, you can put it in the chat, or we can definitely answer the question towards the end. I just want to go ahead and pass it over to Ms. Shauna Taylor. She's a well-known realtor in Hampton Roads.
We did have one question, actually. Are these resources only for Chesapeake residents?
So I'm gonna say yes for the program I'm in for the Chesapeake redevelopment residents. Yes, for the Chesapeake residents. Yes.
Okay, thank you.
You're welcome.
Hey everybody, I'm just waiting for my stuff to come to the screen. But my name is Shonda Taylor. Thanks for the introducing, Greg. I definitely appreciate it. And today I'm going to talk about like budgeting your way to home ownership and kind of what that looks like. And it should be up shortly.
By the way, I can now notify you of breaking news updates. All right, so here we go in just a second. All right, so I like to call this the money playbook. I give this to a lot of clients who reach out about home ownership, but are kind of a little uncomfortable about saving or knowing what to save or how to save. So if we could just go to the next slide. All right, so you're ready to buy a house, but is your money ready? And that's like anytime you talk to a realtor about leasing or buying, the first thing they ask you is, have you talked to a lender, or like, what's your budget? That's because that's the most important piece of the process, kind of understanding how much you'll have available to spend so we'll know what to look for. So I'm just going to break down a few ways that you can start saving your money, or at least know what to expect when it comes to the money. All right, so there's a couple of steps that we're going to talk about here. The first steps is how to fix your credit score, how lenders use your credit score, how to improve your credit score if needed, your payment calendar, your debt to income ratio, saving for your down payment, creating a savings plan, determining how much you can afford, and the types of loans that you will come across once you start the pre-approval process, and then just how to pay your mortgage down faster, and just a little checklist for you and like the next steps if you kind of can check off the things that I'm giving you here. All right, next slide.
All right, so the first steps to prepare your money for buying a home. What you want to do is that if you have anything that is open and active on your credit report, you want to make sure you pay those items on time. I tell all of my clients that credit is about how well you manage debt. So if you close something, you lose points because you're no longer managing it. If you are late on something, that's like mismanagement, so you lose points for that too. Or if you let things go into charge off or repossession, those are the things that can definitely hurt your credit score. So you want to pay attention to your payment history. You also want to be familiar with your debt to income ratio. Your debt to income ratio pretty much tells a lender, because basically what they do is they take the amount of debt owed on your credit report, right? And they divide that by your income, and that's how they come up with the percentage for your debt to income ratio. So you want to be mindful of those two things. Next slide. All right, so there's some expenses with purchasing a home. There are programs out to help alleviate some of the expenses, but the expenses that you want to be prepared for are the down payment, of course, closing costs. You have to understand your mortgage is a combination of your principal, taxes, insurance, and interest. And then you want to have like a rainy day account for emergency repairs and updates for appliances if need be. Ongoing expenses, of course, is going to be the mortgage, because the mortgage is sometimes for 15 to 30 years. Keep in mind, you do not have to live somewhere 15 to 30 years just because you plan to buy. And your insurances are going to be forever, because you want to protect the biggest investment that you have. And then there's always taxes. We're going to pay taxes till the day we are no longer here. If you do decide to move into somewhere with an HOA, kind of understand that HOAs can increase over time. And then you have things like regular repairs and upgrades or renovations if you choose to do so. Next slide. All right, so here's a little bit about your credit score. Banks use your FICO score. They don't use Credit Karma. They don't use your Vantage score, which are some of the options that you see for free. That's why sometimes you could check your credit score on an app, but if somebody pulls your credit, then it's two different numbers and it's like a wide variation. So your FICO score is comprised of this wheel on the left. I think it's my right, I'm sorry. But it's the one on the page, how your FICO score breaks down. So you have 10% for type of credit, 10% for like recent applications or new credit, 35% for payment history, 30% for credit utilization, and 15% for length of credit. When I'm gonna get to the questions after the presentation. When I am helping someone fix their credit, I always tell them to bring down the utilization or any open active credit cards and make sure they always pay at least the bare minimum on time to keep them from being late, because that is overall 65% of your credit score. So if you're doing those two things right, then you can kind of help increase your credit score faster. Next slide. All right, so how lenders use your credit score. There's good credit and there's bad credit. Good credit is someone who doesn't use a lot on their credit card and they always pay on time. Bad credit, you might go over 50% of your limit, meaning if your card is $1,000 and you always spend $500, $600 and you're paying the minimum amount, ideally they want to see you at about 30%. And then this kind of goes back to the previous slide about managing the score. Next slide. All right, so how to improve your credit score when you are preparing to buy a house. I know for me, I am a write it down. Like if I write it down, I'll understand it. So when I started preparing myself to purchase a house, all the bills that I had, I wrote it down with the date that it was due, the amount that was due. And a lot of stuff went on auto pay, especially like my loans and credit cards, because the minimum payment was like $25. But I knew I could manage the smaller payment. And if I wanted to pay more to bring it down faster, I could. But at least I'm meeting the bare minimum requirement of being on time. Next slide. All right, so this is just a blank calendar. And with everybody attending, I can have the actual money playbook emailed to you. So if you want to use this calendar for a month and year to go ahead and start writing in like your paycheck periods and what date the bills are due in the gray squares, kind of similar to the previous slide. Next slide. All right, so pulling your credit report. I always have my clients pull their credit report from two places. We pull it from annualcreditreport.com because since the pandemic, annualcreditreport.com has been providing credit reports free weekly. It does not give you a score, but it will show you the information that's on your credit report. And then I always have them use My FICO because My FICO is what the banks actually use. Now, My FICO is a little pricey, so you can plan to use it for a month or two just to kind of gauge where you are, or if you want to see like if the things that you're doing is actually improving your score. My FICO gives you daily alerts when anything on your credit report changes as well. All right, so this, no, you're fine. You could go back to, well, this is the formula. Go back one slide for me. All right, so this is the formula that is used to calculate your debt to income ratio. And again, what lenders do is they take all the debt that's reported to the credit report versus your income. This formula, I'm sorry, is for your utilization. So remember I was saying if you have $1,000 credit card, $300 is the ideal limit amount that you want to report when it reports to the credit bureau. So 30% is ideally a good space to be in, 30% and under. Anything over 30% starts to indicate that you kind of like need the card. So it negatively impacts your credit score. So that's how you can figure out your utilization by this particular formula in the gray box. Next slide. All right, now we're talking about your debt to income ratio. So again, this is where the lenders take everything that is on your credit report or coming out of your paycheck, and they divide that by your gross monthly income, and that's what gives them the percentage for your debt to income ratio. And to answer your question, what's the ideal debt to income ratio? 43% as a DTI is the highest a borrower can have, with some exceptions, and still qualify for a mortgage. All right, so here is a way you can calculate your debt to income ratio. So it just asks you to kind of take in or make note of your monthly expenses and your monthly income, and it breaks down the formula for how to do that there. Next slide. All right, saving for your down payment. Down payments are typically the type of down payment that I see is 3.5% of the sales price, because these are FHA loans, which are backed by the government. Yes, years ago, 20% was the status quo, but the government realized that, hey, not everybody can afford 20%. I know if I would have been required to put down 20% on my home, I wouldn't own it. Because it's just kind of hard to achieve that amount of savings. So what they did was they came up with FHA, and FHA reduced the 20% to 3.5%. And a good rule of thumb to calculate that is for every 100,000, 3,500 would be the down payment, which is a lot more obtainable for a lot more borrowers in the market. All right, so we can go to the next slide. All right, so you can create your own savings plan. This is kind of where you got to deep dive into your finances and be honest with yourself about your monthly income and the source and the things that you still have to, you know, is an expense for you to be able to survive. So this expense plan or savings plan is created for you to be able to fill in the blanks. I would give a generalization, but literally your credit score, just like your finances, is very, very unique to you. So it has to make sense to you. All right, next slide. And that's just some extras for you to write out certain expenses. I always tell people, be honest with what you can really afford. I come across a lot of people who count themselves out when it comes to mortgage pre-approval. They'll say, oh, well, I got a couple of collections, I know I'm not going to be approved. The lender doesn't look at the negative items the same way we do. I also have clients who could get approved for a really large amount, but hey, let's have that conversation. Are you going to be comfortable with the payment that comes along with this large amount? I know the bank said you can get it, but what would you like to do? Where do you want to stay? So I always have this conversation with everybody just to be open and honest. If you know you want to keep your mortgage at 1,500, 1,600, that is nothing to be embarrassed or ashamed about, because at the end of the day, this is your debt that you have to pay back. So you just got to be honest with yourself about what you can really afford and what you want to pay on a monthly basis. Next slide. All right, and don't forget to consider additional monthly fees and payments like insurance, taxes. The good news about that, though, insurance and taxes is included in your mortgage. It actually goes in an escrow account. And when you close on your home, you're paying those things up for 90 days. Next slide. All right, special note for self-employed home buyers. I do deal with a lot of entrepreneurs as well. And the biggest obstacle that they face is their taxes. I was employed for years, and if I had any issues with my payroll or 401k or, insurance accounts, I could go to HR. But a self-employed person, they don't have the option to do that. They are their HR. They are responsible for reporting their income to the IRS. So it just looks a little bit different when a mortgage company or a lender is going through their financials. So I talk to them a lot about having that stuff in order so that they can present their stuff to a lender for pre-approval. Next slide. All right, so there are a lot of home loans, y'all, and I know this is a lot of information, so I do want to make sure you guys get a copy of this. There's conventional, adjustable rate, and fixed rate. I don't recommend adjustable rate because that means your mortgage could fluctuate, as well as because the rate fluctuates. I do recommend fixed rate. That way you know what your principal and interest is going to be regardless of if taxes and insurance fluctuate. Next slide. All right, so this gives you some insight about conventional loans. And I know I said earlier, like, history shows that conventional loans usually requires about 20% down, but there are lenders with conventional loans who will go down to 5%, or even some of them do 3.5% as well to be competitive in the market. Conventional loans are usually like creme de la creme of the loan product, right? It says this person has a very strong credit score, they have the savings, and they're able to utilize a conventional loan. Next slide. Adjustable rate loans, which I don't like, meaning the rate can fluctuate based on what the market is doing. It's a little risky. It could provide you with a very, very low rate, but in 2 years it could balloon, or 2 years it could go up by 3, which is a lot when we're talking about hundreds of thousands of dollars. Next. Fixed rate tends to be my friend. This usually applies to the 15, 20, and 30-year mortgages. This is where your rate is set. No matter what's going on in the market, your rate will be your rate. And the only thing that could change your payment are outside forces such as taxes and insurance. Next. All right, jumbo loans are usually, I can't remember what the amount, but at one time it was usually like loans over 600,000 were considered to be jumbo loans, where they would need about 10 to 20% down, a FICO score of 700, and the lenders look for the debt to income ratio to be exceptionally low, like 45% or lower, and then they must show that they have the assets or cash to qualify for the jumbo loan. Next. All right, government insured loans, which I work with very often. I haven't had the pleasure of doing USDA just yet because I haven't sold a home in what's considered a rural area. But there are VA loans, which are backed by the government for veterans. And then there is FHA loans, which are also backed by the government. And this is where they reduce the credit score requirement, and they also reduce the down payment amount. So VA loans actually don't have a down payment. They do come with a funding fee, and then FHA loans do have a down payment of about 3.5%. Next. All right, so some pros and cons of government insured loans. They help you finance a home that you might not traditionally qualify for with the conventional loan. The credit requirements are a little bit lower. You don't need as large of a down payment. They offer the best terms and flexibility, and they are available to new and repeat buyers. Cons, they do come with mortgage insurance, also known as private mortgage insurance, PMI, and then they do have a higher overall cost, and extensive documentation is required. So if you've ever seen someone kind of going through the home loan process and they say they keep asking for this and they keep asking for that, they're going to ask for stuff till the day you close. Next. All right, so this is like some inside information on how to pay your mortgage down faster when you get one. Things that you can do to increase your equity. If you owe less and the house is worth more, then you're entitled to what's called equity. I always tell all my clients, keep your credit good. I had one young lady call me the other day. We purchased her home for $100,000. She did $40,000 worth of renovations using a FHA 203K loan. Her house is now worth about $130,000, and the bank will lend a certain percentage of that equity. So she has access to about $75,000 in cash, which is life-changing, because if she wanted to pull that money out and, you know, look to purchase another property or start a business, she would be able to do so. And all from purchasing a home a couple of years ago. I think she bought in like 2019, and in 21 her value shot up like crazy. So I tell people, once you get the house, even though it's the biggest purchase you'll ever make, keep your credit good, because your equity could be the gift that keeps on giving. Next slide. And then here's just a checklist of things that you would want to make sure you have in order. Kind of going over everything that we talked about. Get your credit score together, reviewing your credit reports, calculating your credit utilization, create a bill payment schedule, calculate your debt to income ratio, determine the price range you're considering being in, determine how much of a payment you'll need, review your timeline. Remember, this is unique to you. I don't care if 50 people around you are closing on a home. When it's your time, it'll be your time, and your process will be smooth sailing. Make your plan towards saving your down payment, create a savings plan, use the online mortgage calculator for an idea of how your monthly payments will be, review loan types to see what's going to be the best option for you, talk to a lender, and then talk to your accountant if you're self-employed. Next. And this is it. This is the end of the presentation. If you have any questions, comments, or concerns, feel free to reach out to me, and I will be more than happy to help.
Thank you so much for that information. We have two questions on queue. It says, where are we as a community in regards to trauma-informed practices?
I think that's for
Greg?
Here we go. Good question. You know, it's a very good question, because I just came from the other day about trauma-informed practices, actually, and it really deals with really this being prepared, for as knowing your budget, knowing consequences, and knowing what you really want to do. And it depends on each individual is different, of course, because you deal with different barriers. So it's one of the key things for as trauma informed is understanding, I'm being a little transparent, your background, what types, what environment that you're in, and understanding, where you're trying to go, basically. I hope that kind of answers a bit. And I think you're on mute. There you go.
you so much. Thank you. And the other question, Ms. Taylor, I think you answered previously, which was, what is the ideal debt to income ratio?
43% or less is where lenders like to see the debt to income ratio.
All right, fabulous. Thank you so much. I don't see any other questions on queue unless anybody wants to ask any other questions. And if you come up with any questions in particular after tonight's webinar is over, or you need any additional information or resources, do contact us at FACE, F-A-C-E, at cpschools.com. Well, this concludes A Place to Call Home webinar. Again, I would like to thank our panelists for sharing information with us this evening. Please remember this webinar has been recorded and will be uploaded to Chesapeake Public Schools YouTube page within the next several days. Thank you for joining us this evening. Remember, families and communities work better together. Thank you.